Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
Welcome back to the Deep Dive. Today, we are opening up a file that's usually reserved for the boardroom.
Or maybe the panic room.
Or the panic room, yeah, depending on how things go. We are looking at the high-stakes world of mergers and acquisitions, M&A.
It is the ultimate corporate drama. It has everything.
Yeah.
Ego, billions of dollars, betrayal, and occasionally a happy ending.
It really is, and you see the headlines every quarter. Company A buys Company B for $50 billion. It's always framed as this, conquering hero moment.
Right. CEO shaking hands, stock tickers flashing.
Exactly. But the research stack we're looking at today tells a much darker, or at least a much more complicated story. It suggests that most of the time, the champagne probably should have stayed in the fridge.
It's the open secret of Wall Street. I mean, depending on which study you read, and we have a huge stack of data here, somewhere between 70 and 90% of mergers fail.
70 to 90.
Fail to deliver the value they promised on day one.
That number is just wild to me. I mean, imagine if an airline landed only 30% of its planes. You would never get on board.
Never.
Yet companies keep buying each other.
Yeah.
Constantly. So our mission today is to figure out why. We want to dismantle the architecture of a deal. Why do they do it? Why does it usually blow up? And how do the finance pros, the people holding the calculators, actually distinguish a disaster from a gold mine?
We're going to peel back the layers. We need to move past the press release buzzwords and look at the actual mechanics.
Yeah.
We'll talk about the elusive concept of synergies. We'll dissect the magic behind, say, the Disney-Pixar deal, and frankly, autopsy the disaster that was AOL Time Warner.
Well, let's start with the psychology of this, or maybe the logic. If the failure rate is that high, why is M&A such a standard part of the CEO playbook? Is it just ego, or is there a rational engine driving this thing?
There is a rational engine, but it's often running on, let's say, high-octane anxiety.
Yeah.
In the materials we have, the rationale usually breaks down into three main buckets: growth, strategy, and efficiency. But if you look closely at the subtext of those, the biggest driver is often speed.
Speed? How so?
Well, think about it. If you're a massive legacy company and you realize the world is shifting, maybe everyone is moving to mobile phones or artificial intelligence.
Right, or electric vehicles, something huge.
Exactly. You have a choice. You can build that capability in-house, but that takes years. You have to hire the talent, do the R&D, fail a few times, and try again.
And while you're doing that, the market is just moving away from you.
Precisely. Or you could just write a check and own the company that's already doing it. It's the classic make versus buy decision. M&A is often just a very expensive way to buy time.
So it isn't just, I want to be bigger, it's, I need to survive, and I can't build this fast enough.
That's the charitable interpretation and, often the correct one. But there are other motivations mentioned in the data. Sometimes it's purely defensive.
Oh, interesting.
You buy a competitor just to take them off the board. You're securing market share by eliminating a threat.
The if I can't beat 'em, buy 'em strategy.
That's the one. And then there's the scale argument. This is where efficiency comes in. The logic is simple. If we get bigger, we can bully our suppliers into lower prices, or we can spread our fixed costs over more units.
Which sounds great on a spreadsheet. But the sources highlight a massive caveat here. They say, rationale is not value.
That is the critical distinction.
Right. Just because you have a good reason to buy a house doesn't mean you're getting a good deal on the house.
Exactly. You can have the perfect strategic logic. We need this tech to survive. But if you overpay by 50%, you still destroyed value for your shareholders. Value creation isn't about the idea. It's about the execution and the price discipline.
Which brings us to the most dangerous word in the corporate dictionary. I swear, every time a deal is announced, the CEO goes on TV and says, we are going to unlock incredible synergies.
Synergies. It sounds like magic.
It does, but what does it actually mean, mathematically?
Mathematically, it's the attempt to prove that 1 + 1 = 3. It's a justification for paying a premium. If company A is worth $10 and company B is worth $10, why would you pay $15 for company B? You only do it if you think the combined entity is worth $30. That extra value is the synergy.
And where does that extra value come from? The sources split this into two camps: cost synergies and revenue synergies. Let's break those down.
Okay, so cost synergies are the ones Wall Street loves because they're hard numbers, they're predictable.
Hmm.
But this is the unpleasant reality of M&A. When they say cost synergies, they usually mean redundancies.
Right. You don't need two HR departments. You don't need two sets of accountants.
Exactly. You fire the duplicate staff, you close the duplicate headquarters, you consolidate your IT contracts. If both companies were buying steel separately, now you buy twice as much, so you demand a 10% discount. That goes straight to the bottom line. It's brutal, but it's mathematically easy to model.
Okay, so that's cutting the fat. That explains the savings. What about revenue synergies? That sounds more optimistic.
It is more optimistic. Revenue synergies are the growth plays. This is cross-selling.
Like, hey, bank customer, you have a checking account with us. Now that we bought this insurance company.
Why don't you buy a policy too?
Exactly.
Or using a global distribution network to sell a local product you just acquired.
That sounds great in theory. So why are the finance people in our source material so skeptical of that?
Because revenue synergies rarely happen on schedule. It's easy to cut a cost. You just stop spending the money. It's really hard to force a customer to buy a second product.
Mm-hmm.
The sources explicitly state that finance teams should haircut revenue synergies. Basically assume they'll be half of what the marketing team promises.
Haircut is a very polite way of saying we don't believe you.
Pretty much. And this is where the trouble starts. If you justify a multi-billion-dollar price tag based on revenue synergies that never materialize, you're underwater. You paid for growth that never happened.
Let's look at some real-world receipts. The research stack has some fascinating case studies. I want to start with the gold standard mentioned in the notes. Disney and Pixar back in 2006.
This is the textbook example of strategic fit.
But looking back, it wasn't obvious, was it? Disney paid $7.4 billion. People thought Bob Iger, the CEO, was, well, crazy.
They did. But you have to look at the problem Disney had at that specific moment. In 2006, their animation department, the literal heart of the company, was flatlining.
They hadn't had a massive hit in years.
No, they were relying on sequels and direct-to-video stuff. Pixar, on the other hand, couldn't miss. They had Toy Story, Finding Nemo, The Incredibles. They had the magic.
So Disney bought them to fix a broken heart?
Yes. But the genius wasn't just the purchase, it was the integration. Usually, when a big corporate giant buys a cool creative studio, they smother it.
They send in the suits, change the culture, and all the creative talent leaves.
Right, which destroys the very asset you just bought. You buy the golden goose and then you starve it.
Yeah.
Bob Iger did something different. He essentially promised Steve Jobs and the Pixar team that he would wall them off. He protected their culture. He let Pixar be Pixar. Disney just provided the distribution machine and the capital.
So they bought the IP, but they didn't break the engine that created the IP.
Correct. And the finance outcome. It revitalized the entire company. It wasn't just the box office, it was merchandise, theme parks, sequels. That $7.4 billion looks like an absolute bargain today.
Okay, let's contrast that with another success story in the notes. Facebook buying Instagram. This one feels different.
Very different. This wasn't fixing a broken apartment. This was spotting a tidal wave before it hit the shore.
This was 2012. Facebook buys Instagram for roughly $1 billion. At the time, Instagram had, 13 employees?
And zero revenue, not a dollar.
People laughed at Mark Zuckerberg. They called it vanity capital.
They did. But look at the price discipline analysis in our source. The argument here is that Zuckerberg saw that mobile was the future. Facebook was struggling on mobile. Instagram was native to it.
So he was buying a threat.
He was buying a threat, but he was also buying network effects before they fully matured. If he had waited until Instagram was making money, say 3 years later, that price tag wouldn't have been $1 billion.
It would have been $50 billion.
Or Google might have bought them. He bought the potential and turned on the monetization later. The ROI on that deal is probably one of the highest in corporate history.
Okay, those are the fairy tales, the ones they teach in business school. Now we have to look at the car crashes. And the sources dedicate a lot of space to AOL and Time Warner.
Ah, yes. The worst merger in history. The cautionary tale that keeps finance professors employed.
This was announced in January 2000, right at the absolute peak of the dot-com bubble. What was the synergy pitch? Because on paper, it sounded kind of logical.
The pitch was old media meets new media. Time Warner had the best content, movies, magazines, CNN. AOL had the pipes, the dial-up internet connection into every American home.
So push Time Warner content through AOL pipes.
That was the theory. But the reality was a complete failure of operational reality. First off, the cultures were at war. Time Warner was suits, 3 martini lunches. AOL was aggressive, tech-focused, hoodies and pizza. They hated each other.
And the technology changed, right? I still have the sound of a dial-up modem in my nightmares.
It changed rapidly. AOL's business model was dial-up. People paying by the hour. Broadband was coming. So AOL's value was about to fall off a cliff just as the deal closed.
That's terrifying. They anchored the whole deal to a technology that was about to expire.
And they assumed putting the two companies together would magically fix the problems of both. Instead, the integration paralysis made everything worse. They ended up writing down almost $100 billion in value.
100 billion. Gone.
Poof, gone.
Let's talk about another failure that's more about the nuts and bolts. Sprint and Nextel. I remember Nextel, the walkie-talkie button,
The chirp?
the push-to-talk feature. It was iconic. Construction sites everywhere ran on Nextel.
Right, so Sprint buys them. The goal was scale. Combine the customer bases, compete with Verizon and AT&T. Why did this fail so badly?
This wasn't just a culture clash. This was a classic case of ignoring technical due diligence. Turns out you can't just mash two phone networks together.
They weren't compatible. Not at all. Sprint ran on a technology called CDMA. Nextel ran on a proprietary system called IDEN. They were different languages. You couldn't just hand a Sprint customer a Nextel phone. It wouldn't work on the towers.
So they had to run two separate networks.
For years. And that just kills your cost synergies. Remember, the whole point of efficiency is to run one network. They had to maintain 2 sets of towers, 2 support teams.
It sounds like a nightmare.
It was. The call quality dropped, customers got angry and left, and the value just evaporated.
So in both these failure cases, the strategy on the PowerPoint slide completely ignored the reality on the ground.
That is a recurring theme. Strategy is abstract, integration is physical. If the wires don't connect or the people hate each other, the strategy is worthless.
So who is supposed to catch this? You have these finance teams, investment bankers. Are they just asleep at the wheel?
Well, this brings us to the agency problem. You have to look at the incentives, the investment bankers. They often get paid a success fee only if the deal closes.
So they want the deal to happen, no matter what.
They desperately want the deal to happen, the CEO. They often get a pay bump for managing a larger company. The only people really paid to be the gatekeepers are the internal finance team and the board.
And the sources paint the finance team as the adults in the room. What's their actual job during this process?
Their job is to stress test the fantasy. When the marketing team says, we'll grow 20% next year, the finance team has to model, okay, what if we only grow 2%? Does the deal still work?
The downside case.
Exactly. They have to assess the integration costs. In the Sprint case, someone should have asked, how much will it cost to switch everyone to one network? And put that number in the model.
They also decide how to pay, right? Cash versus stock.
That's a huge strategic lever. If you think your stock is overvalued like AOL did in 2000, you want to pay with stock. You're using expensive currency. If you think your stock is undervalued, you try to pay with cash.
It's basically currency trading with your own company shares.
It is. And then once the deal closes, the finance team shifts into policing mode. We call this synergy realization.
Tracking the receipts.
Literally. If you promise the board $100 million in savings, the finance team produces a report every month showing exactly where that money is.
We closed the Cincinnati office, that's $2 million.
We renegotiated the software license, that's $5 million. Exactly. Because if you don't do that, the savings usually get eaten up by business as usual. Managers will just spend it elsewhere.
So you're basically the internal auditor of everyone's dreams.
It's not the most popular job. No one likes the person saying no. But as we saw with AOL and Sprint, the alternative is destroying the company.
Okay, let's zoom out for a second. We've covered a lot of ground. If a listener sees a big merger announcement tomorrow, what's the mental checklist they should run through?
Based on our deep dive today, I'd look for 4 things. First, strategic fit. Does this solve a real problem, like Disney needing creativity, or is it just getting bigger for the sake of it?
Okay, logic first.
Second, cultural alignment. Do these companies actually operate the same way? Or is it a suit versus hoodies situation?
Because culture eats strategy for breakfast.
Every time. Third, integration plan. Are they acknowledging how hard it's going to be to merge the tech or operations? And finally, and most importantly, price discipline.
Are they paying a price that allows for mistakes?
Exactly. Even a great company is a bad investment at the wrong price. You need a margin of safety.
It's funny, looking at it through this lens, M&A feels less like strategy and more like risk management.
That is exactly what it is. It's a calculated bet. And like any bet, the house usually wins, unless you really, really know what you're doing.
Here's a thought to leave you with, something that stuck with me reading these files. We live in a world that celebrates growth. We celebrate the empire builder. When a CEO buys a rival, they get put on the cover of magazines.
They get called titans of industry.
Right. But if the research shows that 70% of these deals fail, if they actually destroy wealth, why don't we celebrate the CEO who doesn't do the deal? The one who looks at the overpriced target, looks at the integration risk, and just says, no thanks, we'll build it ourselves.
The art of doing nothing.
Exactly. The discipline to say no. That rarely makes headlines, but it might just be the most valuable skill in the modern corporate world.
It's certainly the one that saves the most money. Sometimes the best deal is the one you walk away from.
Something to think about the next time you see billions flashing across the ticker. That brings us to the end of this deep dive. Hopefully your detector for corporate hype is a little more calibrated now.
Always a pleasure to break down the numbers.
Thanks for listening. We'll catch you on the next deep dive.
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.